Before we dive in, a critical disclaimer. I am not a licensed financial advisor, and this video is for educational and informational purposes only. It should not be taken as financial, legal, or tax advice. The world of finance is complex, and your personal situation is unique. Please always consult with a qualified and certified professional before making any major financial decisions, especially one as significant as using your home as collateral. What if I told you that inside the walls of your home, there might be a financial tool so powerful that some call it a homeowner's secret weapon, but so misunderstood that others call it a ticking time bomb? This is a tool that can fund your dream kitchen renovation, pay for your kids' entire college education, eliminate all your high-interest credit card debt, or even launch the business you've always dreamed of. But, and this is a very big but, if you misunderstand it, if you misuse it, if you don't respect it, it has the power to cost you the one thing you've worked so hard for, your home itself. That tool is called a HELOC, a home equity line of credit. And right now, in the United States, there is an estimated $2 trillion in tappable home equity. Let me say that again. $2 trillion. It's a staggering amount of wealth, a mountain of cash, locked away inside American homes. And the vast majority of homeowners either don't know it's there, or they're too intimidated by the confusing jargon and scary warnings to even consider touching it. They hear words like lien position, collateral, variable rates, and their eyes glaze over. They see headlines about foreclosure and they run in the other direction. And I don't blame them. The financial world often feels like it's designed to be confusing. But what if we could change that? What if we could break it all down piece by piece in plain English so that you know exactly what you're dealing with? That is the entire purpose of this video. We are going to demystify the HELOC. We're going to cut through the noise, translate the banker speak, and give you a crystal clear understanding of what this thing actually is. By the time we're done, you will understand how it works, the powerful advantages it offers, the serious risks you must avoid, and most importantly, you'll have the confidence to decide if a HELOC is the right move for you and your family. We're going to turn that confusion into clarity, and that fear into confidence. So, let's start at the very beginning with the most important word in the entire equation: equity. What on earth is home equity? The simplest way to think about it is this: your house is like a piggy bank. When you first bought your home, let's say for $400,000, the bank put in most of the money, and you put in a small down payment. Over the years, two things happen. First, you make your monthly mortgage payments. Every single time you send that check, you're chipping away at what you owe the bank, and you're putting a little more money into your piggy bank. You are converting debt into ownership. Second, the housing market does its thing. Hopefully, your home's value goes up. If that $400,000 house is now worth $550,000, that extra $150,000 of value also got dropped right into your piggy bank. So, your equity is the difference between what your home is currently worth and what you still owe on your mortgage. It's the part of the house that you and only you truly own. It's your skin in the game. It's your wealth. And for decades, that wealth has just been sitting there, trapped. You couldn't really use it unless you sold the house. But that's where the HELOC comes in. A HELOC is basically a special key that unlocks that piggy bank while you are still living in the house. It lets you access a portion of that equity to use for other things. Now let's break down the name itself because it tells you everything you need to know. HELOC. H is for home. This is critical. The entire system is built upon the value of your home. Your house is the collateral. That's the fancy word for saying you are pledging your home as a guarantee that you will pay the money back. This is what makes a HELOC both so powerful and so risky. Because your home is on the line, banks are willing to give you much better interest rates than they would for an unsecured loan like a credit card. But it's also why you have to be so careful. E is for equity. As we just discussed, this is the magic ingredient. You cannot get a HELOC if you don't have equity. The bank will typically let you borrow up to a certain percentage of your home's value, usually around 80 or 85% minus what you still owe. That calculation determines your maximum credit limit. L is for line. This is maybe the most misunderstood part of a HELOC. This is not a lump sum loan. When you get a traditional home equity loan, the bank cuts you a check for, say, $50,000, and you immediately start paying interest on the full amount. A HELOC is different. It's a line of credit. Think of it exactly like a credit card. The bank approves you for a maximum amount. Let's say $100,000. But you don't get a big check for 100 grand. Instead, you get what is essentially a superpower checking account or a special credit card with a $100,000 limit. You can draw money from it as you need it. If your kitchen renovation costs $30,000, you take out $30,000. You only pay interest on the $30,000 you've actually used, not the full $100,000. If you need another $5,000 for a new water heater a few months later, you can take that out too. You use what you need when you need it, up to your limit. And finally, C is for credit. It's a line of credit. This means it's revolving. As you pay back the principal amount you've borrowed, you can then borrow it again, just like a credit card. If you take out $30,000 and then pay back $10,000, you once again have that $10,000 available to use for something else. This flexibility is the HELOC superpower. It's an emergency fund on standby. It's a renovation fund you can tap into project by project. It's a financial safety net built from the value you've created in your own home. This flexibility is structured into two distinct phases. First, there's what's called the draw period. This is usually the first 10 years of the HELOC. During this time, you can withdraw money as you need it, up to your credit limit. Your monthly payments during this period are often very low. Sometimes they are interest-only payments. This means you're only paying the interest that's accumulating on the amount you've borrowed. You're not even required to touch the principal. It keeps your cash flow flexible. After the draw period ends, you enter the repayment period. This can last anywhere from 10 to 20 years. At this point, the account is frozen. You can't borrow any more money. Your job now is simply to pay back the remaining balance, both the principal and the interest. Your monthly payment will be recalculated to ensure the entire loan is paid off by the end of the term. So your payments will almost certainly go up, sometimes significantly. So to recap the absolute basics, your home's value creates equity, like money in a piggy bank. A HELOC is a key that gives you a flexible line of credit to access that money. You use it like a credit card during the draw period, and then you pay it all back during the repayment period. It sounds simple enough, right? And in principle, it is. But the details are where the danger lies. What kind of interest rate will you get? Is it fixed or variable? What are the fees? How does the bank calculate your home's value? And what are the biggest mistakes that can turn this incredible financial tool from a dream come true into a total nightmare? Now that we have the foundation, the solid ground of what a HELOC actually is, we can start building on it. We can start to explore the real-world applications and, more importantly, the questions you absolutely must ask before you ever sign on that dotted line. Because understanding the concept is one thing. Knowing how to use it wisely is everything. So let's put this into a real-world context. Meet David and Emily. They're a typical American couple. They bought their house 5 years ago for $300,000. They've been making their mortgage payments on time, every single month like clockwork. Over those 5 years, two amazing things happened. First, they paid down a portion of their mortgage principal. And second, the housing market in their neighborhood went on a tear. Their home, which they bought for $300,000, just got appraised for $500,000. Suddenly, David and Emily are sitting on a gold mine of $200,000 in home equity. It's not cash in their pocket, of course. It's wealth trapped inside the walls of their house. But they have big plans. Their kitchen is straight out of the 1980s. They want to build a deck for summer barbecues. And they have some nagging high-interest credit card debt from a medical emergency last year that's been costing them a fortune in interest. They hear about a HELOC. The bank tells them they can get a line of credit for up to $100,000, secured by their home's equity. Sounds perfect. Feels like free money. They see it as a magic wand they can wave to fix all their financial pressures and finally get the home of their dreams. But like any powerful tool, a magic wand can be incredibly dangerous if you don't understand exactly how it works. And the most critical concept to understand is that a HELOC operates in two very distinct phases. This is non-negotiable. You have to get this. The first phase is called the draw period. Think of this as the open for business phase. It typically lasts for 10 years. During this decade, David and Emily's $100,000 HELOC works almost exactly like a credit card. They're given a special checkbook or a debit card linked to the account. Let's say the kitchen renovation costs $40,000. They write a check from their HELOC account to the contractor. Boom! They've now used $40,000 of their $100,000 line. Now here's the key part of the draw period. Their monthly payment is incredibly low. Why? Because most HELOCs during the draw period are interest only. This means David and Emily are only required to pay the interest that accrues on the $40,000 they borrowed. They aren't touching the principal, the actual $40,000 itself, at all. If their interest rate is, say, 6%, their monthly payment is just around $200. Feels unbelievably affordable. A few months later, they decide to build that deck. It costs another $15,000. They use their HELOC again. Now they've borrowed a total of $55,000. Their interest-only payment goes up to about $275 a month. Still very manageable. They see that credit card debt with its outrageous 22% interest rate and decide to pay it off. They pull another $10,000 from the HELOC. Now they're up to $65,000 borrowed. Their monthly HELOC payment is now about $325, but they've eliminated a credit card payment that was costing them even more. They feel like financial geniuses. They've consolidated debt, upgraded their home, and their monthly cash flow has actually improved. This is the seductive power of the HELOC draw period. Feels like a financial cheat code. But what happens when the draw period ends? This is where the story changes, and it's the part that gets so many people into serious trouble. When that 10-year draw period is over, the HELOC enters its second phase, the repayment period. The open for business sign is turned off. The checkbook is no longer valid. The faucet is shut. They cannot borrow any more money from the line of credit. And now the bill for the last 10 years comes due. For the next 20 years, that's the typical length of a repayment period. David and Emily have to pay back the $65,000 they borrowed, plus interest. Their loan reamortizes. That's a fancy word for your payment is recalculated. Instead of being an interest-only payment of $325, it's now a principal and interest payment. Their new monthly payment could easily jump to $500, $600, or even more, depending on the interest rate. This is what we call payment shock, and it's a very real danger. Imagine your budget is built around a $300 payment for 10 years, and then 1 month, without warning if you weren't paying attention, it doubles. That's how people lose their homes. But there's another, even more volatile piece to this puzzle: the interest rate itself. Unlike a fixed-rate mortgage where your rate is locked in for 30 years, the vast majority of HELOCs have a variable interest rate. This means your interest rate can and will change over time. Your HELOC's rate is typically tied to a benchmark financial index, most commonly the U.S. prime rate. The bank will quote you a rate like prime plus 1%. So if the prime rate is at 5%, your HELOC rate is 6%. But the prime rate isn't static. It's heavily influenced by the Federal Reserve. When you hear on the news that the Fed is raising interest rates to fight inflation, that directly impacts the prime rate. Let's go back to David and Emily. They took out their HELOC when the prime rate was low at just 3%. Their rate was prime plus 1. So they were paying a comfortable 4%. But over the next few years, the economy changes. The Fed raises rates multiple times. The prime rate shoots up to 8%. Now David and Emily's HELOC rate is 9%. Look what happens to their interest-only payment during the draw period. That $65,000 they borrowed at 4% was costing them $217 a month in interest. Now at 9%, it's costing them $487 a month. Their payment has more than doubled, and they haven't even entered the repayment period yet. They haven't borrowed another dime, but their monthly obligation has skyrocketed, all because of a factor completely outside of their control. This is the hidden risk of a HELOC. Its flexibility is its greatest strength, but the variable rate is its potential Achilles heel. You are essentially making a bet on the future of interest rates. So how do the banks decide how much they're willing to let you borrow in the first place? It all comes down to a simple but crucial calculation called the combined loan-to-value ratio, or CLTV. Lenders use this to gauge their risk. They want to make sure that if you default and they have to foreclose, there's enough value in the home to cover both your primary mortgage and the HELOC. Most lenders will cap your CLTV at 80 or 85%. Let's break it down using David and Emily's numbers. Their home is worth $500,000. The bank's maximum CLTV is 85%. Step 1. Calculate the total amount the bank is willing to have in loans against the property. $500,000 times 85% is $425,000. This is the absolute ceiling. Step 2. Subtract what they already owe on their primary mortgage. Let's say their current mortgage balance is $240,000. So, we take that ceiling of $425,000 and subtract the $240,000 they already owe. The result is $185,000. This is the maximum potential HELOC the bank would be willing to offer them. It's the total available equity the bank is comfortable letting them tap into. Understanding this calculation is your first piece of homework. Before you ever talk to a lender, you should have a rough idea of your home's value and your current mortgage balance. You can run this calculation yourself to set realistic expectations. Now, you grasp the mechanics, the two phases, the variable rate risk, and how the bank determines your limit. You're already ahead of 80% of the people who sign up for these things. But this is just the engine of the car. We haven't talked about the sticker price, the hidden fees, the dealership tricks, or the fine print in the owner's manual that could leave you stranded. What about the introductory teaser rates that lure you in, only to balloon a few months later? What are the annual fees, transaction fees, and inactivity fees that can slowly bleed you dry? And what is the single most dangerous clause that could be buried on page 17 of your agreement? A clause that gives the bank the right to freeze or even reduce your line of credit at the worst possible time, right when you need the money most. Getting the loan is one thing. Not getting taken for a ride is another. And that fine print, that little clause, can turn your financial safety net into a trapdoor. So let's talk about it. What does it actually mean for a bank to freeze or reduce your credit line? It means that the money you were approved for, the money you're counting on, can vanish overnight without your permission. Imagine this. It's 2007. A guy named David in Phoenix, Arizona, has a great job, 2 kids, and a beautiful home with a ton of equity. He's a smart guy, financially responsible. He decides to open a $100,000 HELOC. Not because he needs the money right now, but for peace of mind. It's his just-in-case fund. If the roof leaks, if a medical emergency pops up, he's covered. He sleeps better at night knowing that money is there. A year later, 2008 happens. The entire financial world implodes. The housing market in Phoenix gets absolutely decimated. David's home value plummets. Then he gets laid off from his job. It's a brutal 1-2 punch. But he thinks, okay, this is terrifying. But this is exactly why I got the HELOC. I can use that $100,000 to pay my mortgage and keep my family afloat while I find a new job. He goes to draw on the funds. Denied. He calls the bank, confused and panicked. And the person on the other end of the line calmly informs him that due to current market conditions and the significant decline in his property's value, his home equity line of credit has been frozen. The $100,000 he was counting on? It's gone. The safety net wasn't just pulled away. It was never really there to begin with. The bank decided the risk was too high, so they shut off the tap. David's story isn't an isolated incident. This happened to hundreds of thousands of Americans. And the scary part is, the bank was completely within its legal rights. That clause buried deep in the agreement gave them the power to do it. This isn't just a history lesson. The triggers for a freeze or reduction are still very much alive today. The most common trigger is a substantial drop in your home's value. Just like with David, if you have a $200,000 HELOC on a $500,000 home, and the value of that home drops to $400,000, the bank might see you as a much bigger risk. They might slash your credit line from $200,000 down to $100,000, or freeze it entirely. But it's not just about your home's value. Your personal financial health is under a microscope. If you start missing payments not on the HELOC but on your credit cards, your car loan, anything, the lender can see that. They pull your credit report periodically. If your credit score tanks because of other debts, they can get nervous and freeze your line. They see you as a drowning swimmer, and instead of throwing you a life preserver, they pull it back into the boat. Even a major change in your financial situation, like losing your job, can be a trigger if the lender finds out. It's a cruel irony. The exact moments you would need the money most are the exact moments the bank is most likely to take it away. So how do you protect yourself? You have to go on the offensive before you sign. You need to ask the loan officer point blank, show me in the contract the specific conditions under which you can suspend, reduce, or terminate my line of credit. Make them point to the exact paragraph. And then you read it. And you read it again. You're looking for phrases like material adverse change or decline in property value. Understand what gives them the power. The second thing is to treat your entire financial life as if it's connected, because it is. Paying your Visa bill on time is part of keeping your HELOC healthy. Maintaining a strong credit score is your best defense. And finally, the most important lesson from David's story. A HELOC should not be your only emergency fund. It's a powerful tool, but it's a tool that can be taken away. You still need 3 to 6 months of living expenses sitting in a boring, safe, high-yield savings account that no bank can ever touch. Now, assuming your line of credit doesn't get frozen, you need to understand the fundamental structure of how a HELOC actually works, because it operates in 2 very distinct phases, and mistaking one for the other is a recipe for disaster. These phases are called the draw period and the repayment period. Think of the draw period as the honeymoon phase. This is typically the first 10 years of the loan. During this time, the HELOC acts like a giant credit card secured by your house. You're given a credit limit, say $100,000, and you can borrow money from it as you need it. You can take out $10,000 for a kitchen remodel, pay it back, then take out $20,000 for college tuition a year later. You can borrow and repay as many times as you want up to your limit. And here's the seductive part of the draw period. Many lenders only require you to make interest-only payments on the amount you've borrowed. If you've drawn $50,000 at a 6% interest rate, your minimum monthly payment might only be $250. Feels incredibly cheap, incredibly manageable. It's easy to get comfortable. It's easy to borrow more because the payments are so low. This is where people get into trouble. They see the low payment and forget they're not actually paying down a single penny of the principal they borrowed. They're just treading water. But the honeymoon doesn't last forever. At the end of that 10-year draw period, the party stops. And it stops abruptly. You enter the second phase, the repayment period. When this happens, two things change immediately. First, your line of credit is closed. You can no longer borrow any more money from it. The checkbook the bank gave you is now useless. Second, and far more importantly, the loan balance you have, whatever you've borrowed that you haven't paid back, gets converted into a traditional loan that you must pay back both principal and interest over the remaining term, which is usually 15 or 20 years. This is what we call payment shock. And it is a brutal awakening. Let's go back to that $50,000 balance. During the draw period, you were happily paying $250 a month in interest. But now, in the repayment period, that $50,000 is amortized over a 20-year term. Suddenly, your new monthly payment isn't $250 anymore. It's more like $450. It almost doubles overnight. And that's if interest rates haven't gone up. If they have, it could be even higher. Imagine your budget is built around that lower payment for 10 years. You've gotten used to it. And then suddenly you have to find an extra $200 every single month for the next 20 years. That's a car payment. That's a full grocery bill. For millions of people, that's the difference between making it and not. They get blindsided because they were only looking at the low introductory payment, not the fully loaded payment that was always waiting for them at the end of the road. It's a ticking clock that starts the second you take out your first dollar. And if you're not prepared for the alarm to go off, the consequences can be devastating. You've successfully navigated the risk of a credit freeze, only to be ambushed by a payment you can no longer afford. So you understand the risk of the bank pulling the rug out from under you. And you understand the ticking clock of the repayment period. But there's another trap, one that's woven into the very fabric of most HELOCs, and it has to do with the type of interest rate you choose. Picking the wrong one can be just as devastating as that payment shock. It's the silent poison in your financial plan. The variable rate trap, and how it can cause your payments to spiral out of control, even during the honeymoon phase. Let's dissect this trap piece by piece. Starts with a number. A beautiful, tantalizingly low number. The bank calls it an introductory rate or a teaser rate. It might be 2.99%, 3.99%, maybe even lower. And when you see that number, your brain does some quick, happy math. You think, wow, I can borrow $50,000, and my payment will only be a couple $100 a month. This is a no-brainer. I can finally build that deck, remodel the kitchen, and pay off that high-interest credit card. You feel smart. You feel like you've just unlocked a secret financial cheat code. This is the bait. And millions of Americans take it every single year. Imagine a guy named Mark. Mark and his wife have been dreaming of a new kitchen for a decade. They've got the plans drawn up, they've picked out the cabinets, but the $25,000 price tag has always been just out of reach. Then a flyer for a HELOC arrives in the mail. It advertises a rate of 3.5%. Mark does the math. The interest-only payment on a $25,000 draw would be just over $70 a month. $70. They spend more than that on coffee. Feels like free money. They go to the bank, the loan officer is friendly, the paperwork is simple, and within a few weeks they have a line of credit ready to go. The demolition crew starts work on the kitchen. Life is good. For 6 months, Mark makes his tiny $70 payment and feels like a financial genius. But what Mark didn't fully grasp, what was buried in the dense, eye-glazing pages of the loan agreement, was the formula that would govern his financial life for the next 20 years. He wasn't really signing up for a 3.5% loan. He was signing up for a loan that was temporarily 3.5%. His real rate was based on a completely different set of numbers. Every variable rate HELOC is built on two core components: the index and the margin. First, the index. Think of the index as the public wholesale cost of money. It's a benchmark interest rate that the bank doesn't control. It goes up and down with the wider economy. The most common index used for HELOCs in the United States is the prime rate. When you hear on the news that the Federal Reserve raised interest rates, the prime rate almost always goes up by the exact same amount almost instantly. It's a public roller coaster, and by signing up for a variable rate HELOC, you've just strapped yourself into the front car. Second, there's the margin. This is the bank's profit. It's a fixed percentage that gets added on top of the index. If the index is the roller coaster, the margin is the extra fee the bank charges you for the ride. And here's the crucial part: the margin never changes. It's their guaranteed slice of the pie for the entire life of the loan. It might be 1%, 2%, or 3% depending on your credit and the lender. So, your actual interest rate, the one you'll be paying for years and years, is the index plus the margin. This is called the fully indexed rate. Let's go back to Mark. His teaser rate of 3.5% was just a temporary discount to get him in the door. His loan agreement stated that after 6 months, his rate would convert to the prime rate plus a margin of 2%. When he signed the papers, the prime rate was, let's say, 5.5%. So his fully indexed rate at that time would have been 7.5%. That's more than double his teaser rate, but maybe still manageable. But here's where the trap springs. During the 6 months Mark was enjoying his new kitchen and low payments, the economy shifted. The Federal Reserve, worried about inflation, began raising interest rates aggressively. By the time Mark's introductory period ended, the prime rate was no longer 5.5%. It was now 8.5%. So what's Mark's new interest rate? It's the new prime rate of 8.5% plus his fixed margin of 2%. His new rate is 10.5%. Let's look at the payment shock. His interest-only payment on that $25,000 wasn't $70 a month anymore. At 10.5%, it was now almost $220 a month. It more than tripled overnight. The $70 coffee budget line item just became a car payment. And Mark is stunned. He calls the bank, confused, and the friendly loan officer now sounds like a robot, explaining the terms of the agreement he signed. It's all there in the fine print. And the bleeding doesn't stop. 3 months later, the Fed raises rates again. The prime rate ticks up to 8.75%. Mark's rate automatically adjusts to 10.75%. His payment creeps up again. A few months after that, another hike. Now his rate is 11%. His monthly payment, which started as a laughable $70, is now a painful $230, and it's still climbing. The dream kitchen now feels like an anchor, dragging his family's budget underwater. Every news report about the economy now fills him with a deep, sickening dread. He's no longer in control. The Federal Reserve is now setting his monthly budget. Now you might be thinking, but don't these loans have caps? A ceiling on how high the rate can go? And yes, they do. But these safety nets are often not as safe as they sound. There are typically two types of caps. A periodic cap limits how much the rate can increase in a given period, say 2% in 1 year. And a lifetime cap sets the absolute maximum rate you could ever be charged, which is often a shockingly high 18%. Let's apply that to Mark's situation. A 2% annual cap sounds reasonable, right? But if your rate starts at 7.5%, it can go to 9.5% in year 1, 11.5% in year 2, 13.5% in year 3, and so on until it hits that terrifying lifetime cap of 18%. The cap doesn't prevent the pain. It just slows down the poison, allowing your rate to double or triple over a few short years. And that 18% lifetime cap? That's not a safety net. It's a financial cliff. Can you imagine paying 18% interest on a $100,000 loan? That's $18,000 a year just in interest. It's a guaranteed path to financial ruin. The variable rate trap is so effective because it preys on our tendency to focus on the present. We see the low initial rate and the affordable initial payment, and we anchor our entire decision on that short-term reality. We underestimate the risk of future rate hikes because, in that moment, the future feels distant and abstract. The bank is betting on this. They are betting that you will be seduced by the low teaser rate and won't fully appreciate the long-term risk you're taking on. So, how do you avoid this trap? Is there a way to get the flexibility of a HELOC without strapping yourself to this unpredictable roller coaster? The answer is yes. You have to look for specific features that give you, the borrower, control over your interest rate. One of the most powerful tools is a fixed-rate conversion option. This allows you to take a portion or all of your outstanding balance and lock it into a fixed interest rate for a set term, like a traditional loan. You get the best of both worlds: the flexibility of a line of credit when you need it, and the stability of a fixed-rate loan once you've drawn the funds. Some lenders even offer fixed-rate HELOCs from the very beginning, though they are less common. Choosing a HELOC with a fixed-rate option is like choosing a car that has both an accelerator and a brake, instead of one that's just stuck in drive, speeding up and slowing down with the flow of traffic. It puts you back in the driver's seat. But even if you find a HELOC with a fixed-rate option and you sidestep the variable rate trap, you're not out of the woods yet. There's another, equally devastating payment shock waiting for many unsuspecting homeowners. It has nothing to do with interest rates and everything to do with time. It's the critical and widely misunderstood difference between the draw period and the repayment period. A transition that can cause your monthly payment to jump by 500% or more, even with a fixed rate. And that is a cliff that far too many people walk right off of. Think of a HELOC not as one single loan, but as a two-act play. Act 1 is the party. It's fun, it's flexible, it's full of possibility. This is called the draw period. Act 2 is the cleanup. The party's over, the lights are on, and now it's time to pay the bill. This is the repayment period. The problem is, most people are so busy enjoying the party in Act 1, they completely forget that Act 2 is coming, and the bill is a whole lot bigger than they ever imagined. Let's break down Act 1, the draw period. This is typically the first 10 years of your HELOC. During this time, your HELOC acts like a superpowered credit card. You have a set credit limit, say $100,000, and you can draw from it whenever you want, for whatever you want. Need $20,000 for a kitchen remodel? Done. Need $5,000 for a medical bill? Just write a check or use the debit card the bank gave you. You can borrow money, pay it back, and borrow it again over and over, as long as you're within that 10-year window and under your credit limit. It's incredibly convenient. And here's the most seductive part of the draw period. The payments are usually tiny. Why? Because in most cases, you're only required to pay the interest on the money you've borrowed. This is called an interest-only payment. You are not required to pay back a single penny of the principal, the actual money you borrowed. Let's see what that looks like. Imagine you've drawn $80,000 from your HELOC for a big project, and your interest rate is a nice low introductory rate of say 2.99%. Your minimum monthly payment would only be about $199. Think about that. You just got access to $80,000, and your budget only has to absorb a $200 monthly payment. Feels like a magic trick. Feels like free money. And for 10 years you can live in this reality. You get used to that tiny payment. It becomes a normal line item in your budget, right next to your Netflix subscription. Meanwhile, that $80,000 mountain of debt is just sitting there. It hasn't shrunk at all because you've only been paying the interest, the fee for borrowing it. You've essentially been renting the bank's money. And then one day the calendar flips. 10 years have passed. The draw period ends. The party is over. Welcome to Act 2, the repayment period. This is the moment that financially cripples unprepared homeowners. The rules of the game change overnight, and they change dramatically. First, your ability to borrow more money is shut off. The credit line is frozen. You can no longer draw from it. Second, and far more importantly, your loan begins to amortize. That's a fancy word that means you now have to start paying back the principal plus the interest. The bank wants its $80,000 back, and it wants it back over the remaining term of the loan, which is typically 15 or 20 years. This is the cliff. This is the payment shock. Let's go back to our example to see just how brutal this can be. You've been comfortably paying your $199 a month for years. You've got an $80,000 balance. But over those 10 years, interest rates have gone up, which is common for variable rate HELOCs. Your introductory rate is long gone, and now your rate is, let's say, 9%. And your repayment period is set for the next 10 years. So, what's your new monthly payment? Your new payment, to cover both the $80,000 principal and the 9% interest over a 10-year term, is now $1,013 per month. Let me repeat that. Your payment went from $199 to $1,013. That is a 409% increase. Overnight. 1 month you pay your usual $200. The next month, you get a statement from the bank demanding over $1,000. And it will be over $1,000 every single month for the next 10 years. This is the 500% jump we talked about, and as you can see, it is not an exaggeration. Simple, terrifying math. Imagine getting a bill in the mail that says you suddenly have a second car payment or a second mortgage payment that you never planned for. That is what payment shock feels like. Your entire household budget, so carefully crafted for years, is instantly obsolete. The money you had allocated for savings for retirement, for your kids' college fund, or even just for groceries, is now being consumed by this HELOC payment that has morphed into a monster. This is not a rare occurrence. It happens to thousands of Americans every single year. They get caught up in the ease and convenience of the draw period. They treat their home equity like a checking account, making only the minimum interest-only payments, because that's all the bank requires. They think, "I'll deal with the principal later." But later always comes, and it comes like a freight train. Let's quickly tell the story of a hypothetical couple, John and Sarah. 10 years ago, they took out a HELOC to add a beautiful new deck to their home. The payment was so low they barely noticed it. A few years later, they used it to pay for a dream vacation to Hawaii. A leaky roof? Put it on the HELOC. A new car transmission? HELOC. Each time they just focused on the small manageable increase to their interest-only payment. They never really looked at the total balance, which had crept up to $65,000. They always planned to pay it down, but life just kept happening. Then, 10 years and 1 month after they opened the account, the letter came. Their $300 a month payment was now $950. Panic set in. They didn't have an extra $650 a month. They were forced to make devastating choices, slashing their retirement savings, selling their second car, and giving up any hope of a vacation for the foreseeable future. They walked right off the cliff because no one ever clearly explained the two acts of a HELOC. So how do you avoid this? How do you enjoy the party of the draw period without facing a financially catastrophic cleanup? Comes down to 3 crucial steps. First, know your end of draw date. The day your loan switches from the draw period to the repayment period is the single most important date on your HELOC agreement. Find it, circle it on your calendar, set a digital reminder for 1 year out, 6 months out, and 1 month out. Do not let this date sneak up on you. Second, you must understand your repayment terms before you sign. Is the repayment period 10, 15, or 20 years? A shorter period means a higher monthly payment. What happens to your interest rate? Does it stay the same or can it change? Read the fine print, and if you don't understand it, ask the loan officer to explain it to you in plain English until you do. And third, and this is the most important piece of advice I can give you, never ever treat the minimum payment as your actual payment. From day one of your HELOC, you should have a plan to pay down the principal. Even if the bank only requires an interest-only payment, you should voluntarily pay more. Calculate what your fully amortized payment would be, and try to pay that amount each month. If you borrow $20,000, don't just pay the $80 interest payment. Pay $300 to start chipping away at the principal immediately. Your minimum payment is a siren song, luring your budget onto the rocks of future financial disaster. By paying down the principal during the easy, flexible draw period, you neuter the threat of payment shock. When the repayment period finally arrives, the balance will be much lower or even zero, and the transition will be a gentle slope instead of a terrifying cliff. Understanding this two-act structure is the key to using a HELOC as a powerful tool instead of letting it become a devastating trap. But the structure is only half the battle. The other half is governed by the engine of the loan itself, the interest rate. And the choice between a variable rate that can change with the market and a fixed rate that's locked in stone is one of the most consequential decisions you'll make. And the right answer is not always the one you think. This is the fork in the road. It's the moment where two homeowners with identical homes and identical equity can end up on wildly different financial paths 5 years from now. One might be celebrating having paid off their new kitchen at a bargain price, while the other is staring at a monthly statement that's doubled, wondering where it all went wrong. The difference? One tiny decision about how their interest is calculated. Let's break this down. First, you have the variable rate HELOC. This is the wild card. It's the charismatic, exciting option that often lures you in with a stunningly low introductory rate. The bank will advertise something like 1.99% for the first 6 months. And you think you've hit the jackpot. And for those first 6 months you have. Your payments are incredibly low. You feel like a financial genius. But variable means exactly what it sounds like. It varies. It changes. It's not loyal to you. This rate is tied to a benchmark, an economic index that moves up and down with the broader market. The most common one in the United States is the prime rate. Think of the prime rate as the interest rate that big banks charge their most trusted, A-plus corporate clients. When you hear on the news that the Federal Reserve has raised interest rates, the prime rate almost always follows suit within a day or two. And when the prime rate goes up, your HELOC rate goes up with it. It's not a question of if, it's a question of when and by how much. Your loan documents will specify the formula. It'll say something like prime rate plus a margin of 1%. So if the prime rate is 5%, your rate is 6%. If the prime rate skyrockets to 8%, your rate is now 9%. That 1% margin is the bank's profit, and it stays constant. The prime rate is the part that floats, taking your monthly payment along for the ride. So who in their right mind would sign up for this kind of uncertainty? Well, there are a few scenarios where it makes perfect sense. First, the savvy house flipper. They plan to buy a property, use a HELOC to fund the renovations, and sell it all within 6 to 12 months. They're betting they can get in and out before interest rates have a chance to rise significantly. They take advantage of that low introductory rate to keep their costs down and maximize their profit on a short-term project. Second, the optimist. This is someone who genuinely believes interest rates are about to go down. They look at the economic forecasts and think, the Fed is going to have to cut rates soon. They're willing to take the gamble that the rate will fall, saving them money over the long term. It's a high-stakes bet on the direction of the entire U.S. economy. And third, the person with a very specific short-term need. Maybe they have a balloon payment on another loan due in 90 days, or they need to bridge the gap between selling one house and buying another. They know they can pay the HELOC off in full very quickly. For them, the long-term risk of a rate increase is practically zero. On the other side of the street, you have the fixed-rate option. This is the polar opposite. It's the steady, predictable, maybe even slightly boring choice. But boring in finance can be beautiful. With a fixed rate, the interest rate you're offered on day one is the interest rate you will have for the life of that loan. If you lock in at 7%, it will be 7% when the economy is booming, it will be 7% when the economy is in a recession, and it will be 7% when your loan is almost paid off 10 years from now. The peace of mind this offers is immense. You can budget with absolute certainty. You know exactly what your payment will be every single month, which allows you to plan your finances for years into the future. There are no surprise spikes, no panic calls to your lender, no watching the financial news with a knot in your stomach. The trade-off? You pay a premium for this stability. A fixed rate will almost always be higher than a variable rate's introductory offer. The bank is taking on all the risk of future rate increases, and they charge you for that insurance policy in the form of a higher starting rate. So while your neighbor with the variable rate HELOC is bragging about their 2% introductory rate, you might be starting at 6% or 7%. Can feel like you're losing the game at first. But let's play that out. Imagine two neighbors, both taking out a $50,000 HELOC for a home office renovation. Neighbor A takes the variable rate at 3%. Neighbor B takes the fixed rate at 6%. For the first year, neighbor A is paying half the interest. They're feeling great. Then the economy shifts. The Fed raises rates multiple times to fight inflation. Over the next 2 years, the prime rate jumps 5 percentage points. Neighbor A's HELOC rate, which was 3%, is now 8%. Their minimum payment has more than doubled. Suddenly, their budget is thrown into chaos. They're cutting back on other expenses, stressed about making the new, higher payment. Meanwhile, neighbor B is completely unfazed. Their rate is still 6%. Their payment is exactly the same as it was on day one. They are sleeping soundly. Who looks like the genius now? The fixed rate option is for the planner. It's for the person who says, I am renovating my house over the next 5 years, and I need to know with 100% certainty what my financing costs will be. It's for the risk-averse homeowner who values a stable budget over the potential for a short-term win. Now, for years, this was a black and white choice. You had to pick a side. Team variable or team fixed. But the banking world evolved and a third hybrid option emerged, and this is something many people don't even know to ask about. It's the ability to lock in a fixed rate on portions of your HELOC balance after you've already opened it. Here's how it works. You might have a $100,000 variable rate HELOC. You use $40,000 to pay for a new roof. You see interest rates starting to creep up and you get nervous. So you call your bank and say, I want to lock in that $40,000 balance. The bank will then convert that portion of your debt into a fixed-rate, fixed-term loan. It's almost like a mini-mortgage that exists inside your larger line of credit. You'll now have a predictable monthly payment on that $40,000 for, say, the next 10 years. Meanwhile, The remaining $60,000 of your credit line is still available for you to use at the original variable rate. This feature offers incredible flexibility. You can use the variable rate for small short-term expenses you know you'll pay off quickly, and lock in the big long-term debts for that all-important predictability. It's a powerful tool, but you have to ask for it. Not all HELOCs offer this conversion option, and those that do often have rules about how many times you can do it or the minimum amount you can lock in. So the decision rests on a deep, personal understanding of your own finances and your tolerance for risk. Are you playing the short game or the long game? Do you want the lowest possible cost right now with the risk of it rising later? Or are you willing to pay a little more today for the guarantee of stability tomorrow? There is no single right answer, only the right answer for you. It requires an honest assessment of your financial situation and your temperament, because choosing the wrong one for your personality can lead to years of unnecessary stress. But even after you've wrestled with this, even after you've picked the perfect rate structure for your life, the journey isn't over, because the interest rate is only the most obvious cost. Lurking in the fine print of every HELOC agreement is a minefield of other charges, a series of trapdoors designed to separate you from your money. We're talking about fees, and the ones they don't advertise are the ones that can hurt the most, sometimes costing you thousands before you've even drawn a single dollar from your account. Let's start with the most common one, the application fee. It sounds innocent enough, right? A small fee, maybe $50 to $100 just to get the process started. But here's the first question you need to ask. Is it refundable? Many lenders will tell you it's to cover the cost of pulling your credit report and initial paperwork. Fair enough. But what if you get denied? Or what if you find a better offer elsewhere and decide to back out? Does that money just vanish? For many lenders, the answer is yes. It's a small price to pay to lock you in psychologically. You've already spent money, so you're more likely to see it through, even if a better deal comes along. But that's just the welcome mat to a whole hallway of costs. The next door you'll have to unlock is the appraisal fee. This is a big one. The bank isn't just going to take your word for what your house is worth. They need an independent, professional appraiser to come out, inspect your property, and give it an official valuation. This is non-negotiable, and it's not cheap. You can expect to pay anywhere from $300 to $800, sometimes even more depending on your location and the complexity of your property. And here is the absolute kicker: you pay this fee up front, and you pay it whether you get approved for the HELOC or not. Let me repeat that. You could pay $500 out of your own pocket, have the appraiser come out, and then have the bank turn around and say, "Sorry, you don't qualify." Or, "Sorry, your home isn't worth as much as we need it to be." That $500, gone. It's the price of a ticket to a game you might not even be allowed to watch. You are literally paying the bank for the privilege of being judged. Next in this gauntlet of upfront costs are the title search and title insurance fees. This is where the bank's lawyers get involved, and whenever lawyers get involved, you know your wallet is about to get lighter. A title search is when they dig through public records to make sure you, and only you, have the legal right to the property. They're looking for liens, which are basically claims against your property from other creditors. Maybe you have an unpaid contractor's bill or an old tax issue you forgot about. The bank needs to know they are in the second position right behind your primary mortgage, with no one else cutting in line. The title insurance protects the lender, not you, the lender, in case some long-lost heir or mysterious lien holder crawls out of the woodwork later on. These fees can run you several $100s more. And finally, to top off this initial cash bonfire, you have the closing costs or attorney fees. Just like when you bought your house, a lawyer or a title company has to handle the final paperwork. They prepare the documents, file the new lien against your property, and make sure everything is legally sound. And for this service, they will happily charge you another few hundred, or even $1,000. Add it all up: the application fee, the appraisal, the title search, the closing costs. Before you have even received the ability to borrow a single penny, you could be out $1,500 or more. That dream of a new kitchen? It just got $1,500 more expensive, and all you've done is fill out paperwork. But a smart borrower might think, okay, that's a tough pill to swallow, but it's a one-time thing. Once I'm past that, I'm in the clear. Oh, if only it were that simple. Because we're now entering the territory of the truly insidious fees, the ones that are designed to slowly drain you over time. I call them the vampire fees because they just keep coming back year after year. The most common of these is the annual fee. That's right. Many banks will charge you a maintenance fee of $50 to $100 every single year, just for the privilege of keeping your HELOC account open. It's like a subscription service to your own equity. You're paying them for the option to borrow your own money. It doesn't matter if you use the line of credit or not. That fee will hit your account every 12 months like clockwork. But it gets even more absurd. Some lenders have what's called an inactivity fee. This is one of my personal favorites because it is so brazenly anti-consumer. They will literally charge you a fee for not borrowing money. You might think, wait, that makes no sense. Why would they penalize me for being financially responsible and not going into debt? The answer is simple. The bank doesn't make money when your HELOC balance is zero. They make money when you borrow and they can charge you interest. An open HELOC with no balance is a risk for them with no reward. So the inactivity fee is their way of poking you with a stick, saying, hey, get in there and borrow something so we can start making some money off you. If you don't draw a certain amount from your line of credit within a year, they hit you with a penalty. It is a system designed to encourage the very behavior you should be trying to avoid: unnecessary debt. Now let's talk about the trapdoor at the exit. You've navigated the upfront costs, you're dodging the annual fees, and you decide you want out. Maybe you found a better rate with another lender, or you've decided to sell your house, or you just want to close the account. You think you could just pay off the balance and walk away, right? Not so fast. Welcome to the world of the early termination fee, also known as a prepayment penalty. This is the bank's golden handcuffs. They will often write into the fine print that if you close your HELOC within a certain period, usually the first 2 to 3 years, you have to pay a penalty. This penalty can be a flat fee of several $100s, or it can be a percentage of your original credit line. It can easily cost you over $1,000 just to leave. Why do they do this? Because they spent money setting up your loan. Remember all those upfront fees they sometimes waive to get you in the door? Well, this is how they claw that money back. They are betting on you staying for the long haul so they can make their profit from years of interest payments. If you try to leave early, they make you pay for their lost potential profits. It effectively holds you hostage, preventing you from refinancing to a better rate you might find elsewhere. So how do you protect yourself from this minefield? How do you walk through this booby-trap temple and come out with the treasure? It starts with one simple but powerful action. You must demand a fee worksheet. Before you sign a single document, before you even agree to an application, you tell the loan officer, I need a complete, itemized list of every single potential fee associated with this HELOC. Upfront fees, ongoing fees, and back-end fees. I want it all in writing. Do not accept vague answers. If they say, oh, it's just the standard closing costs, you say, great. Itemize them for me. If they can't or won't give you a clear, comprehensive list, that is a giant red flag. Walk away. A reputable lender will have no problem providing this. Once you have this list from 2 or 3 different lenders, you can compare them side by side. You'll see that lender A might have no application fee but a huge early termination fee. Lender B might have a higher appraisal fee but no annual fee. Now you can make an informed decision, not an emotional one. And remember, many of these fees are negotiable. Banks are competing for your business. You can say, your competitor is offering to waive the annual fee. Can you match that? The worst they can say is no. But this brings us to the biggest trap of all. The one that looks like a gift. You'll see the ads everywhere. No fee HELOC. Or no closing costs. It sounds like the perfect solution. A way to sidestep this entire mess. But as the old saying goes, there's no such thing as a free lunch. The banks are not charities. If they aren't charging you fees up front, you can be absolutely certain they are making that money back somewhere else. And there's one primary place they do it. A place that can end up costing you 10 times more than all these fees combined. It's your interest rate. More specifically, it's the structure of your interest rate. This is the single most misunderstood, and therefore the most profitable part of a HELOC for the banks. It's a financial labyrinth designed with dead ends and trapdoors, and if you don't have a map, you will get lost, and you will pay dearly for it. Let's start with the billboard you see on the side of the highway. It's from a friendly-looking community bank, and it screams in big, bold letters, home equity lines of credit as low as 3.99%. You see that number and you think, wow, that's incredible. My credit card is charging me 25%. My personal loan is 11%. This is practically free money. And that's exactly what they want you to think. That number is the bait. It's the cheese in the mousetrap. This is called an introductory rate or a teaser rate. It's a temporary discounted rate that the lender offers for a short period, usually the first 6 to 12 months, to lure you in. It's a marketing gimmick. And just like any magic trick, the real action is happening where you aren't looking. While you're mesmerized by that shiny 3.99%, the fine print on page 11 of your agreement is preparing to change your financial life. Because once that introductory period ends, your rate doesn't just go up a little bit. It transforms completely. It skyrockets to what's called the fully indexed rate. And this isn't a fixed number. It's a living, breathing thing that will change over the life of your loan. And it's based on a simple but powerful formula. You absolutely must understand this formula. It is prime rate plus margin equals your interest rate. Let's break that down. First, the prime rate. What on earth is that? In simple terms, think of the prime rate as the base cost of money for banks. It's the interest rate that commercial banks charge their most creditworthy corporate customers. It's the starting point for almost everything. But what controls the prime rate? For the most part, it moves in lockstep with a rate set by the most powerful financial institution in the country, the Federal Reserve. When you hear on the news that the Fed raised interest rates today, they're talking about something called the federal funds rate. When that rate goes up, the prime rate almost always goes up by the exact same amount, often within the same day. So, if the Fed raises rates by 1/4 of a percentage point to fight inflation, the prime rate goes from, say, 8.25% to 8.5% just like that. This is not some abstract economic news. If you have a HELOC, this is a direct announcement that your personal borrowing costs are about to increase. The prime rate is the variable, the unpredictable part of your HELOC. It is entirely out of your control and out of your bank's control. It is dictated by the national economy. Now for the second part of the formula. The margin. If the prime rate is the bank's wholesale cost, the margin is their profit. It's a fixed percentage that the bank adds on top of the prime rate to get your final interest rate. For example, if the prime rate is currently 8.5% and your lender's margin is 2%, your fully indexed rate is 10.5%. Simple as that. Here is the secret that most people miss. The margin is the only part of this equation you can control. It is set in stone in your loan agreement. It will not change for the entire 10, 15, or 20-year term of your HELOC. While the prime rate will dance up and down with the economy, your margin is permanent. This makes it the single most important number to negotiate when you are shopping for a HELOC. 1/4% difference in the margin might not sound like much, but over 2 decades on a large balance it can add up to thousands and thousands of dollars. So, let's go back to those no-fee HELOCs we talked about. Remember how I said they make their money back somewhere else? This is it. This is the main event. A lender might offer you a HELOC with 0 closing costs, saving you maybe $1,000 up front. But to make up for it, they'll give you a margin of 2.5%. Meanwhile, another lender down the street charges you $1,000 in fees, but offers you a much lower margin of, say, 1%. Let's do the math. Let's say you have a $100,000 balance on your HELOC, and the prime rate is 8.5%. With the no-fee lender, your rate is 8.5% prime plus their 2.5% margin. That's an 11% interest rate. Your annual interest cost is $11,000. With the other lender, you paid $1,000 up front, which stings a bit. But your rate is 8.5% prime plus their 1% margin. That's a 9.5% interest rate. Your annual interest cost is $9,500. You are saving $1,500 a year every single year in interest. You made back that $1,000 closing cost in just 8 months. After that, for the next 20 years, you are pocketing an extra $1,500 annually compared to the no-fee loan. Over the life of the loan, that's a staggering difference. You didn't fall for the short-term bait of no fees, and instead secured a long-term victory with a lower margin. But the danger doesn't even stop there. We've only talked about the rate at one moment in time. The real risk of a HELOC is its variable nature. Let's stick with our example. You took the better deal with the 1% margin, so your rate is 9.5%. You're paying about $792 a month in interest on your $100,000 balance. It's manageable. But then inflation stays high. The economy is still running too hot. So the Federal Reserve raises interest rates again. And again. Over the next 18 months, the prime rate climbs from 8.5% to 10.5%. It's a 2% increase. What happens to your HELOC payment? Your margin is still locked at 1%. But the prime rate is now 10.5%. So your new interest rate is 11.5%. Your monthly interest payment on that same $100,000 balance just went from $792 to $958. That's an extra $166 coming out of your family's budget every single month. That's a car payment. That's a week of groceries. That's your kid's daycare expense. And you have absolutely no control over it. If the prime rate keeps rising, your payment will keep rising right along with it. This is the fundamental risk you accept with a HELOC. You are betting that interest rates will stay stable or go down. But if you bet wrong and rates go up, your affordable line of credit can quickly become an anchor that drags down your entire financial life. Now, most HELOCs do have some safety nets called caps. There's usually a periodic cap, which limits how much your rate can increase in a given year, and a lifetime cap, which sets an absolute maximum rate you could ever be charged, often a sky-high number like 18% or even 21%. These caps offer some protection from a catastrophic, overnight spike, but they are not designed to save you from a slow and steady climb in rates over several years. They are a last resort, not a comfortable safety blanket. So you're standing at a crossroads. On one hand, you have this incredible, flexible financial tool. On the other, you have this terrifying, unpredictable interest rate that's tied to the whims of the national economy. It feels like you have to choose between flexibility and stability. But what if you didn't have to? What if there was a way to get the best of both worlds? A way to access your money when you need it, but protect yourself from the storm of rising interest rates by locking in a portion of your balance at a fixed rate. This powerful feature is often called a fixed-rate conversion option, or sometimes a hybrid HELOC. And it is, without a doubt, one of the most significant innovations in home equity lending in the last 20 years. It's the financial equivalent of having your cake and eating it too. Let me break it down. Imagine your HELOC is like a big, flexible checking account secured by your home. You can write checks, transfer money, and pay it back as you go. But the interest rate on that account is like the weather. It can be sunny and calm one day, and a raging hurricane the next. A standard HELOC gives you no umbrella. A HELOC with a fixed rate option gives you an umbrella. In fact, it gives you several. Here's how it works. You still have your main HELOC with its variable interest rate. That's your flexible spending pool. Let's say you have a $100,000 credit line. You use $10,000 for some landscaping, $5,000 for new appliances, and you're paying it back. That $15,000 balance is floating on the variable rate. But now comes the big one. You're ready to pull the trigger on that $50,000 kitchen remodel you've been dreaming about for years. You draw the $50,000 from your HELOC. Your total balance is now $65,000. Now you look at the news. You hear whispers of the Federal Reserve planning to raise interest rates. The last thing you want is for the cost of your beautiful new kitchen to start climbing every single month for the next 10 or 15 years. This is where you deploy the fixed rate option. You call your lender and say, I want to lock in the $50,000 portion I just used for my kitchen. The bank then takes that $50,000 and essentially carves it out from your main variable rate balance. It becomes its own separate fixed rate loan. It's like a mini mortgage living inside your HELOC. This $50,000 slice will now have a fixed interest rate that will never change for the life of that portion of the loan. It will have a set repayment term, say 10, 15, or 20 years, and a predictable, stable monthly payment that you can budget for with absolute certainty. Meanwhile, what about the other $15,000 you used for the landscaping and appliances? That remains on the variable rate side of your HELOC, giving you the flexibility to pay it off more aggressively if you want. And what about the remaining $35,000 in your credit line? It's still there, available for you to use whenever you need it, at the current variable rate. Do you see the power in this? You get the on-demand access of a credit line for smaller, unpredictable expenses, and the stability and peace of mind of a traditional fixed-rate loan for your large, planned projects. You can literally create your own custom-tailored financing solution. Let's talk about the specific advantages because they are huge. First, and most obviously, is predictability. Financial stress often comes from the unknown. A fixed-rate lock eliminates that unknown. You know exactly what your payment will be for that locked portion every month until it's paid off. It transforms a source of potential anxiety into a manageable, predictable budget item. Second is control. In a volatile economy, this feature puts you back in the driver's seat. You're no longer just a passenger on the wild ride of interest rate fluctuations. You can watch the market, and when you feel rates are favorable, you can lock. If you have a balance and hear rates are about to spike, you can make a defensive move and lock in your rate to protect yourself from the coming storm. It's a strategic tool, not just a loan. Third is the sheer flexibility. Many lenders will allow you to have multiple fixed-rate locks at the same time. Let's say you do that kitchen remodel and lock in $50,000. 2 years later, your son gets accepted into his dream college, and you need $30,000 for his first year of tuition. You can draw that $30,000, and then create a second fixed-rate portion for it with its own term and fixed payment. You can essentially have multiple separate projects financed under one single credit line, each with its own stable payment plan. Now, this all sounds incredible, and it is. But as with anything in finance, there are no free lunches. You have to understand the trade-offs and the fine print. First, the fixed rate you lock in will almost always be higher than the variable rate was on the day you locked it. You might have a variable rate of, say, 8%, and the fixed rate option might be 9%. Why? Because you are paying a premium for certainty. The bank is taking on all the risk of future rate increases. By giving you a fixed rate, they are guaranteeing your rate won't go up, even if their own cost of borrowing money skyrockets. That guarantee has a price. Second, there can be fees. Some lenders charge a conversion fee, or a rate lock fee, every time you choose to fix a portion of your balance. It might be a flat fee like $75 or $100. If you plan on locking multiple small portions, those fees could add up. Third, there are usually rules about how and when you can lock. Most banks have a minimum amount you can convert to a fixed rate, often around $5,000. So you can't just lock in $500 for a new TV. They also typically limit the number of active locks you can have at one time, usually 3 to 5. And finally, and this is critical, not all HELOCs offer this feature. Many banks, especially smaller local banks or credit unions, might only offer the traditional, variable rate only HELOC. When you are shopping for a HELOC, this is one of the most important questions you can ask. You need to explicitly ask the loan officer, does your HELOC have a fixed rate conversion option? If they say no, you need to seriously consider if that product is right for you, especially if you're planning a large project or borrowing in a rising rate environment. So, when does using this feature make the most sense? The number one use case is for large defined expenses. A home renovation, a swimming pool installation, a medical procedure, or a down payment on a second property. These are projects where you know the total cost up front. You can draw the full amount in one go and immediately lock it in for a predictable repayment plan. Another incredibly powerful strategy is for debt consolidation. Imagine you have $25,000 in high-interest credit card debt, with rates at 20, 25, or even 30%. You can use your HELOC to pay off all of those cards in a single transaction. Then, you immediately call your lender and lock in that $25,000 balance at a fixed rate that's dramatically lower, maybe 9 or 10%. You've just swapped a dozen high-stress, high-rate variable payments for one single manageable fixed payment that will save you thousands, or even tens of thousands of dollars in interest. This hybrid model truly represents the evolution of the HELOC. It takes a useful but potentially risky tool and adds a layer of security and strategic control that can be a game changer for American homeowners. It allows you to tap into your home's value with confidence, knowing you have the flexibility you need for life's surprises and the stability you crave for its biggest plans. You now understand the mechanics, the pros, and the cons. You're armed with more knowledge than 99% of people who apply for these loans. But knowledge is one thing. Navigating the real-world application process is another. The final piece of this puzzle is knowing exactly what to look for, what to avoid, and the critical questions you must ask any lender before you even think about signing your name on that final application. Getting this last part right is the difference between unlocking your home's potential and getting locked into a financial trap. So let's arm you for that conversation. Think of this as an interrogation where you are the one in the power seat. You are interviewing the bank for the privilege of handling your money, your equity, your future. You walk in with a notepad, and you do not leave until you have a clear, unambiguous answer to every single one of these questions. First, we talk about the rate, the most seductive and dangerous part of the offer. They will hit you with a low introductory or teaser rate. It'll look incredible. Your first question isn't, what's the rate? It's, how long does this introductory rate last? To the exact day? Is it 3 months? 6 months? A year? Get a date. Your very next question is the one that truly matters. After the introductory period, what is the fully indexed rate right now today? This rate is made of 2 parts, the index and the margin. So you follow up. Which specific index do you use? Most lenders use the Wall Street Journal prime rate. If they say anything else, your antenna should go up. You need to understand what that other index is and how volatile it is. Then you ask the million-dollar question. And what is the margin? The margin is the percentage the bank adds on top of the index. This is their profit. It's fixed. It will not change for the life of your loan. An index might be at 5%, and the bank's margin might be 2%. That means your fully indexed rate is 7%. The margin is where you can see the real cost of the loan, and it's where you can compare different lenders apples to apples. A lender with a slightly higher teaser rate, but a much lower margin could save you thousands over the long run. But we're not done with rates. Now you hit them with the safety questions. Is there a lifetime cap on the interest rate? What is the absolute maximum percentage it can ever reach? Federal law mandates a cap, but you need to know what it is. Is it 18%? 21%? You need to imagine that worst-case scenario. And then, is there a floor? What is the absolute minimum the rate can fall to? This shows you the full range of possibilities you're signing up for. Okay, you've dissected the rate. Now we move on to the structure of the HELOC itself, the draw period and the repayment period. Your first question is simple. How long is my draw period? 10 years is standard, but it can vary. During these 10 years, you can borrow and repay funds like a credit card. But then you need to clarify the payments during this time. During the draw period, are my minimum payments interest only? Or are they principal and interest? This is a massive distinction. Interest-only payments are incredibly tempting. They're small, they keep your cash flow high. But remember, you're not reducing your debt by a single penny. You're just renting the money. If you have an interest-only draw period, you need to ask, do I have the option to pay down the principal during the draw period without any penalty? The answer should be yes, but you must confirm. Then comes the cliffhanger question, the one that causes so much shock and panic for unprepared homeowners. What happens on the very first day my draw period ends and my repayment period begins? You need them to paint a crystal clear picture for you. Assuming I have a balance of $50,000 on that day, and assuming the interest rate is at today's fully indexed rate of say 7%, what will my first monthly payment be? Get a real number. The jump from a small, interest-only payment to a fully amortized principal and interest payment can be staggering. It can literally double or triple overnight. This is the payment shock we talked about. You cannot leave that office without knowing exactly what that shock could look like. Next, you clarify the repayment period itself. How long is the repayment period? Is it 15 years? 20 years? And is the interest rate still variable during the repayment period? Or does it lock in? Most HELOCs remain variable, meaning your payment could continue to change for another 2 decades. Finally, on this topic, you ask about freedom. Is there a prepayment penalty if I want to pay off the entire loan early during the repayment period? You might come into some money or want to refinance. You need to know if they'll punish you for leaving early. Now let's talk about the silent killer of any good deal: fees. You need to become a fee detective. Start broad. Can you provide me with a full, itemized list of every single fee associated with opening and maintaining this HELOC? Don't accept a vague answer. Ask specifically, are there closing costs? If so, what do they typically amount to? These can include application fees, appraisal fees, title searches, and attorney fees, sometimes running into thousands of dollars. Then ask, are these closing costs paid out of pocket, or are they rolled into the loan balance? Rolling them in is convenient, but it means you're paying interest on your fees. The interrogation continues. Is there an annual fee to keep the line of credit open, even if I don't use it? Many banks charge $50 to $100 a year just for the privilege. Then a sneaky one. Is there an inactivity fee? Some lenders will actually charge you if you don't use your HELOC, which is absurd. Ask about access. Are there transaction fees for drawing funds? And finally, the exit fee. Aside from a prepayment penalty, is there an early closure or cancellation fee if I close the line of credit within a certain time frame, like the first 3 years? Banks often waive closing costs up front, but they'll claw them back with a cancellation fee if you close the account too soon. You've covered rates, structure, and fees. You're almost there. But the last few questions are about the bank's power over you. The fine print that can change your life without warning. This is the most important question of the entire meeting. Under what specific circumstances can you, the lender, freeze, reduce, or demand full payment of my line of credit? This is your what-if scenario. Lenders have the right to do this. You need to know their triggers. If the value of my home declines significantly, could you freeze my line? If my credit score drops, could you reduce my available credit? What if I lose my job? They might not give you a perfect answer, but their response will tell you a lot about their policies. This is the risk nobody talks about. You could be counting on that HELOC for an emergency, only to find the bank has locked you out when you need it most. Finally, a practical question. What is the exact process for drawing funds? Is it with special checks, a debit card, and online transfer? And how long does it take for the money to be available? You need to know how liquid your line of credit truly is. When you walk out of that bank, you should have a document in your hand with all of these answers written down. You have now transformed a complex, intimidating financial product into a simple set of variables that you control. You can now confidently compare the offer from Bank A to Bank B to Credit Union C. You are no longer just a borrower. You are an educated consumer, the master of your own financial destiny. Throughout this entire journey, from understanding the simple concept of equity to dissecting the complex terms of a loan document, the goal has been to give you one thing: control. A HELOC is not good or bad. It is a tool. A hammer can be used to build a home or to tear it down. It all depends on the person holding it. Your home is not just an asset on a spreadsheet. It's the backdrop to your life's most precious moments. It's your security, your sanctuary, your foundation. Using its equity is a profound decision, one that should be made with wisdom, clarity, and confidence. You now have the knowledge to make that decision. You have the questions to ask. You have the power to weigh the risks and the rewards. So whether you're dreaming of that new kitchen, funding a college education, consolidating debt, or building a safety net for your family, you can now approach that goal not with fear or uncertainty, but with a clear plan. You are the one holding the blueprints. You are in charge. Now go build something amazing.